966.
Let's move to topic one. What will happen with oil in 2022? The IEA on Tuesday upped its average Brent crude oil price assumption for 2022 to $79.40 a barrel. Brent is expected to average $71.50 a barrel this year. Richard, we've talked a lot about oil on the 966 for obvious reasons, but the IEA doesn't talk about oil prices very much. As Reuters notes, this is a rarely published take on prices. The IEA told Reuters that including price assumptions in monthly reports is rare but not unprecedented. But this report is interesting. Richard, let's talk about oil in 2022.
Yeah, this is exciting news. And it sort of affirms what we're seeing. But let's talk about oil. Actually, let's talk about oil prices, and because I think a lot of what we refer to or allude to in our discussions, we sort of assuming an understanding of oil markets, and that's not necessarily fair. I mean, I talk a lot about November 2014 as a pivotal point for Saudi Arabia going forward. So let's talk about the oil prices. I'm going to go back roughly 10 years. So in 2010, the average OPEC basket price, so the price of oil that they were selling as OPEC. So in 2010, I'm going to leave out the decimals. In 2010, it was $107 for the year. 2011, $109 for the year. 2012, $105 for the year. 2013, $96 for the year. So that's basically 4 years at oil prices above $100. 2014, $49. 2015, $40. 2016, $52. 2017, $69, 2018, $64, 2019, $41, 2020, $69. And that's OPEC's basket price. So when you look at this, and this is why 2014 is so pivotal, they're just coming off of basically 100 or more than 100 average price of oil for 4 years running. Price started to plummet, and we know why. We talked about this because of the huge explosion of U.S. shale production. So basically in 2014 and 2015, Saudi oil revenues were halved. And by the way, and this is the genesis of Vision 2030. Those 2 years when they didn't even know what their budget was going to be and if they could continue to sustain any kind of spending level that would be sufficient for their population, is when it became very real, and they moved very aggressively into Vision 2030, which was announced in 2016. So what drives these oil prices, in my opinion? We have Rosneft, I think, just came out and said, there could be $120 oil next year. Bank of America this summer said we're going to break 100. I'm not a believer in that. I don't think we'll see 100 again. Why? Because of U.S. shale. And let's look at some of the numbers. U.S. shale, why? And by the way, the price, I think one of the reasons we're not going to see 100 this year, in 2022, is that U.S. shale is coming back online. Let me get a quote here. The Permian, which is in Texas, is the primary driver of U.S. output at the moment. And during 2020, output from U.S. total oil output dropped by more than 2 million barrels a day. This was, due to coronavirus, and production is gradually returning. And the Permian just had the biggest month of growth that it's had since, I think, since 2014. So it's coming back strong, and the rest of the other fields in the U.S. will come back too, and driven, of course, by price. Now, the reason that this is the case is the Dallas Fed did a very interesting study in 2019, where they found that the oil price that U.S. shale companies need to profitably drill new wells has closely tracked prices for long-dated oil futures since 2014. 2014, remember that pivotal year. The close tracking of the two numbers suggested that the U.S. was seen as the world's marginal producer when it comes to meeting future oil demand. That connection is held through 2020 and this year, despite moments of turbulence in the spot oil market and decline in U.S. rigs. So what it's saying is what I've always said, and other people have said, that Saudi can set the floor on, or OPEC can set the floor on oil price. U.S. shale sets the ceiling. So we've had a great year this year in terms of oil. If you're looking at oil producers, projected to be a better year next year. But we're waking up U.S. shale, and that means, as this says, they're the ones who determine the ceilings. And if the markets in terms of oil futures are sinking off of U.S. shale prices, then the markets will do the same in 2022. So this is great, and this is for the Saudis. All right, let's make hay while the sun's shining, and they should. But I don't see it getting to 100. This is one reason why Vision 2030 and so much of Saudi Arabia's greater fiscal responsibility is so important, because they understood their oil revenues aren't going to. We're not going to have 4 years of $100 oil ever again, probably. Mm-hmm. And so we have to reduce our costs, and we have to find non-oil revenue. And they've done that, as we've seen in their VAT and their other taxes. They're going to bring in $85 billion in non-oil revenue in 2021. They brought in 85 in 2020. They'll probably bring in that or a little more in 2021. So they're moving based on these oil prices. So, the premise was the oil price, as IEA has put out. And we can see that oil prices have driven so much of Saudi policy, and specifically the move into Vision 2030.
This report is interesting. It has a lot of interesting facts in it. For example, U.S. output made up for half the increase in global oil production last month. But right. The IEA doesn't see U.S. production getting to pre-pandemic levels until the end of next year. It's just, right. There's a lot of this. It's really interesting. And obviously what's driving it, I love the phrase, Saudi set the floor, shale sets the ceiling, because shale is more expensive and not as easy to extract oil from the ground, whereas the Saudis and others have it not sitting on the ground, but it's a lot. I mean, their cost to produce per barrel is much cheaper than shale. They just have that advantage.
Exactly. But the thing that shale has done, I mean, in 2014, the average break-even price for U.S. oil producers was, somewhere around 75 in terms of WTI. Mm-hmm. By 2020, it's about 47. So the technology that they brought to bear on extraction has been really transformative. Now, mm-hmm. I will say that it's gone up. The break-even oil prices for U.S. shale producers has gone up over the last year. It's at 57 now. But when you have access to production in which new wells cost about $7 million to drill, and in fact, for many U.S. tight oil, shale oil producers, they have sitting there what's called drilled but uncompleted wells. So they have a lot of these sitting there. So when investors in Saudi oil, U.S. shale oil companies said, okay, we've been pumping cash into this as you expand. We now want dividends and buybacks. So reduce your capital expenses and give us more money back, which is, again, one reason why they're on the sideline, as well as the pandemic. Well, when oil is at $70+ per barrel, they're coming off the sidelines, and they're coming off pretty cheaply and pretty quickly. And that's why they set the ceiling. And that's why the market says this is our marginal producer is U.S. shale oil.
Yeah, it's interesting. Oil prices also have so much politically tied to them. I mean, right now, just the discussion about gas being very expensive in the US is going headfirst into the discussion about how we need to speed up the energy transition away from oil. And right now, a lot of it's falling on the lap of President Biden. Some are calling for him to tap the strategic reserve, which probably won't do much in terms of alleviating prices or inflation at all. But it's really interesting. This is a very political issue. as
It
you
is.
know.
And but they just did an auction for plots in the Gulf of Mexico just recently, and it was very busy and very attractive. In part because I think in future ones there's going to be higher taxes and more restrictions. So they got a good turnout for welling plots in the Gulf of Mexico. And in part, those are apparently deep water wells are less carbon, fewer carbon emissions, so they're attractive in that sense. But yeah, we've got to, the world has got a challenge to mitigate carbon emissions while fueling the planet. So we'll see how we thread this needle.